Hi, everyone. Welcome to United Asset Strategies' first quarter investment call. I'm joined as usual by Jiorden Sanchez and Tom Healy. We're going to take you through a review of the quarter, our outlook, and some positioning decisions we're making within your portfolios. So to start it off, I'll turn it to Jiorden for a review of the equity markets.
Thanks, Matt. So in recapping first quarter performance, I'd like to start off with Exhibit 1 on the left. The stock market, as depicted by the S&P 500, printed double-digit returns in the first quarter. That equity market strength came despite a move higher in interest rates, which contained returns for the bond market, and you see that in the Bloomberg Ag. To provide some context on this market strength, this represents the second consecutive quarter of double-digit equity returns, which has only happened 4 times since the 80s. Now, as noted in prior videos, much of this bull market has been concentrated in a handful of stocks, the Magnificent Seven, with returns for the typical stock a bit more muted. That said, as shown in Exhibit 2 on the right, we've seen the early signs of broader participation, with most stocks and sectors outperforming the market in March. Now, 1 month doesn't make a trend, and market returns and participation will at least be partially a function of the macro environment we're investing in. So at this point, I would like to turn it back over to Matt and Tom, who will provide an update on the economy as well as monetary and fiscal policy. Thanks.
Thank you, Jiorden. As the chart on the left shows, the Fed has raised rates rapidly from near zero during the pandemic and post-pandemic to over 5% today. And while the Fed has not hiked rates additionally since last summer, they've continued to hold at this restrictive policy level, all while continuing to reduce the balance sheet. So while this seems negative, I'll turn it back to Tom to explain a little bit about how economic growth has remained resilient in the face of this tight Fed policy.
Okay, well, thanks, Matt. As Matt mentioned, it's been pretty surprising to see the economy remaining as resilient as it has in the face of persistently high rates, particularly on the consumer side of the economy. Although the most recent data suggests maybe some slowing on the consumer side. However, in the election year, as we mentioned in previous calls, one of the areas that provides a real tailwind for the economy is fiscal policy. As you can see on the right, fiscal policy has been particularly accommodative in the last, say, 2 years. When you look at 2024, things like the infrastructure bill, the Inflation Reduction Act, the CHIPS Act are all provided a tailwind for the economy. In addition, Congress is signing off on a nearly $100 billion aid package to address the war in Ukraine, Israel, and also potential issues in Taiwan. So all of that has really provided an underpinning for stronger economic growth than would have been anticipated. And to see how that affects Fed policy, I'm going to turn it back to Matt.
Thank you, Tom. Yeah, so the strong economy Tom mentions, coupled up with inflation that remains above the Fed's target, has really led for the market and the Fed itself to kind of change their view of the appropriate policy rate to achieve the dual mandate. So as you can see in the chart on the left, if you follow the dotted yellow line to the solid yellow line in 2024, you can see a really big change in expectations for the appropriate Fed funds rate by the market. And that really reflects, to start the year, the market was anticipating 6 or more interest rate cuts this year. And that view has been unwound. And as of the end of the quarter, it was all the way back to 3 interest rate cuts as the baseline expectation for the market. So that has actually had a pretty big impact on interest rates. The chart on the right shows just how this has been impacting the bond market. Generally speaking, when interest rates are rising, this works against bond prices, and the longer a bond is, the more price sensitive it is to interest rates. So you can see, as we're looking at treasuries here, the longer term treasuries showed the biggest loss in the first quarter. What's interesting about this start to the year, however, is due to the inverted yield curve, shorter term bonds and floating rate bonds actually started the year with a much higher coupon than longer term bonds. So the rise in rates kind of exaggerated the performance difference that you saw between floating rate and longer term bonds. So that's how this macro environment impacted the bond market. And to see how it's impacting the equity market, I'll turn it back over to Jordan.
Thanks, Matt. So, we believe the combination of accommodative fiscal policy and restrictive monetary policy has created a pretty unique investment environment. The former has really created a healthy economy with attractive investment opportunities, but the latter has really increased the cost of capital to invest alongside those opportunities. And in doing so, the market really appears to have divided stocks into two groups: the haves, which we'll define as self-financed businesses with excess capital to invest for growth, and the have-nots. These are businesses that rely on outside capital and are now facing added costs to operate. So in Exhibit 6, we bucket first quarter returns into the haves, which we'll define as large cap stocks, higher quality businesses, and the Magnificent Seven, and the have-nots, which we'll define as low quality businesses and small to mid cap stocks. Note how the market has rewarded the haves in the performance chart on the left for their strong balance sheets, which you see in the middle chart, and their strong cash flows, which you see on the right chart. To drive this point home, you see that the Magnificent Seven have more cash than debt on their balance sheet and are generating over 20% cash flow margins on each dollar of revenue. Also note that the exact opposite appears to have unfolded for the have-nots, whose returns have trailed the market due to their weaker balance sheets and cash flows. Along those lines, in our letter, we note that small to mid-sized businesses have 40% of their debt at floating rates, suggesting higher rates are already pressuring their cash flows. So to sum it up, we believe the narrow breadth we've seen in this bull market is at least partially due to the high interest rate environment we're in, which has limited the extent to which many businesses have been able to participate in the broader macro strength we're seeing. Now to the outlook. Going forward, a pullback from recent highs would not surprise us, as there have only been 2 years since the 80s with pullbacks of less than 5%. Along those lines, as of the date of this recording, the market is down over 3% from its highs. Looking beyond these day-to-day gyrations, however, the long-term debate really centers around whether the typical stock catches up to the Magnificent Seven or the Magnificent Seven catches down to the rest of the stocks. Only time will tell, but here are some key data points that make us cautiously optimistic. First, on the Magnificent Seven, their recent run has resulted in heavy market concentration. To put some numbers around that, today, 10 stocks make up 30% of the market, and that's above the prior high of the dot-com bubble, where it was 25%. Now, the dot-com bubble did not end well, but we see a lot less market risk from today's top 10, with fundamentals and valuation suggesting we're not in bubble territory. So beyond the high-quality attributes I outlined earlier for the Magnificent Seven, more broadly, today's top 10 stocks account for 22% of market earnings. That's above the mid-teens for the dot-com era. And while today's stocks trade at a premium multiple, can't deny that, their valuations imply half the premium applied to the top 10 stocks of the dot-com era. Now, turning to the remaining 490 stocks in the S&P 500, their outlook is going to be relatively more reliant on the state of the economy and financial conditions. But with fiscal spending not necessarily slowing and the Fed still signaling future rate cuts, we do see the ingredients for a potential catch-up trade. Now, turning to Exhibit 7, we highlight relatively attractive valuations and a potential inflection in growth for the typical stock. As you see on the left, the market trades at a premium multiple. As of the end of the first quarter, the typical stock trades more in line with its historical average. And as of the date of this recording, the recent pullback has the typical stock trading a turn lower at about 16.5. Further, as shown on the right side of the exhibit, this is happening just as earnings growth for the typical stock is expected to reaccelerate. The most recent data point to support this view comes this morning from earnings. We're about 23% of the way through earnings season, and 79% of companies are beating with an average surprise of 7%. So what does all this mean for your accounts? We continue to have a healthy allocation to the Magnificent Seven due to those strong fundamentals. We just own a little less than the market would dictate because of premium valuations. And as it relates to the rest of the market, we do see value. And as an example, we're overweight energy and small cap stocks to complement our underweight to the Magnificent Seven. We believe this creates an attractively valued barbell to manage around some of the uncertainty we're seeing. On one side, energy would benefit from higher inflation, whereas on the other side, mid-cap stocks would benefit from lower rates. So at this point, I'll just turn it back to Matt to provide a similar outlook and positioning update on what we're doing in fixed income.
Thanks, Jiorden. So just like the equity side, we've been active on the fixed income side as well. And we've really been repositioning in two key areas. So one decision we made was to take another step to further reduce credit risk. And this time we did it by fully exiting preferred stocks. Generally, with the appreciation and continued tightening spreads to treasuries, we found that selling was what we felt was appropriate because you're not exactly getting comped for the risk that you're taking when you're extending into preferred stocks at this point. So we took this time to sell. On top of that, we also did some repositioning around our short-term bonds, our kind of cash-like, highly liquid positions. So as we mentioned earlier, there was a jump in interest rates and short-term floating rate debt performed very well relative to other parts of the bond market. So this was a good thing for us because we had a very healthy amount of short-term floating rate treasuries in the portfolio. We were a little bit concerned about the market being disconnected from the Fed as we entered the year. So as the market began to unwind those rate views, we decided to take the opportunity to sell some of our floating rate treasuries and actually reinvest them in still short-term but fixed rate treasuries. So this enabled us to lock in the 5% plus yields that we're seeing for a little bit of a longer time period, but still keeping duration contained. So that's a little bit of the activity on the bond side. But for some closing remarks, I'll send it back over to Tom.
Thanks, Matt and Jiorden. As you can see, the investment team is parsing through a substantial amount of data in determining our outlook and portfolio positioning. Just taking a step back, looking at the firm as a whole, our advisors and planners are also starting to think through the tax implications with the expiration of the Tax Cuts and Jobs Act, which was the Trump tax cut that expires in 2025. So that's something to start thinking of and speaking with your advisor about. We'd also like to suggest that we continue to grow. One of the implications there is we just added Michael Abate, a veteran of the pension world, to help build out our pension offering. And we're also proud to announce that on May 1st, we're going to be opening up our New Jersey office in Short Hills. We think these types of developments continue to expand our reach and our offering and also give us the ability to better service our clients. So with that, we'll end it here and look forward to seeing you again next quarter. Thank you for your time.